the state of climate tech in Africa, the risks and opportunities that we think we are facing, and the role that all of us can play in addressing some of these opportunities and in the path forward. So let me kick off with a little bit of an overview of what is happening in climate tech globally, and then try and situate that in terms of what it means for us who are operating on the continent. The first theme that I wanted to talk about today is this idea that we are living increasingly in a multipolar climate world. Now, what do I mean by that? It's a lot of jargon. But what it really means is that the location of things like the innovation, of the manufacturing, of the deployment, of the value capture, the location of these things is now happening more and more in distributed places around the world. And we're really seeing a globalizing climate environment. Historically, the US and China were probably dominated the global climate tech narrative. Last year, India had more climate tech IPOs than the US and Europe combined. We're seeing more and more capital flowing, more and more innovation and technology flowing, more supply chains taking place in new countries, new parts of the world, Japan, Korea, Singapore, the Middle East. So it's interesting in a way because for climate tech operators in Africa, those of us who have been running businesses and growing businesses and investing in businesses, we have been cultivating some of these global touch points for many years. We've been traveling some of these global corridors for a long, for a fair amount of time now. So in many ways, the African climate tech ecosystem is really well positioned in this kind of changing global environment. The second theme I think I want to touch on is a shift in prioritization that is happening globally. Not necessarily away from mitigation and sequestration, but certainly towards climate adaptation. There is more and more attention on things like climate adaptation. Maybe this is because of political swings that are happening, in the US and Europe. Maybe this is because people are seeing and feeling the physical effect of climate change. But investment in climate adaptation is becoming, really the flavor of the month. Interestingly enough, for us operating again in the kind of African climate tech ecosystem, this is not a new trend for us. For years, we have been building businesses and investing in businesses focused on climate adaptation. And that's because in Africa, adaptation is a commercial reality. It's an economic imperative. It's not about kind of political or ideological objectives. So again, I think we're fairly well positioned to capitalize on this global trend. Thirdly, hardware's turn. And maybe hardware's turn again. For many years, people started saying, we want to invest in capital-light businesses, asset-light businesses, digital-only, software plays. And suddenly, with the emergence of AI, all of a sudden, software plays and digital-only plays are looking a little bit less defensible, a little bit less differentiated. And so the idea, globally, we're now seeing people investing in real assets, real hardware, real infrastructure, real operations. That creates an interesting opportunity for us on the continent because actually for us, there's always been a physical element to the climate tech story in our region. There's always been physical operations and hardware. And again, maybe we are well positioned for this kind of global trend. Fourthly, there's this concept of a kind of like the great venture capital rethink that's happening around the world. Climate tech investors globally are beginning to debate whether traditional fund models are fit for purpose for climate tech investing. And we are seeing more and more that they are innovating on fund structures. They're developing evergreen vehicles. They're looking at continuation funds. They're looking at secondaries vehicles. They're looking at private equity roll-up strategies. And this is, somewhat ironic for some of the people in this room. And I'm looking around and I know that we've been in conversations this week where people are talking about, is venture capital, traditional fund structures fit for purpose in Africa, fit for purpose for climate tech in Africa? And suddenly, because this has now become a global conversation and a global debate, it makes those challenges and these things that we've been shouting for a few years now a little bit more relevant, a little bit more heard. And finally, the harsh reality is that for global climate tech investors, they are deploying faster than they are able to fundraise, right? So the rate of deployment is happening at a greater pace than the rate of being able to fundraise and replenish the coffers. And that is unfortunately a trend that we are seeing in Africa as well today, and something that we're going to have to be thinking about in the near future, in the years ahead. Let's take a minute to zoom in on some statistics in terms of where we are moment in time, the state of climate tech in Africa. And I'm not going to spend this time regurgitating statistics and data, because probably you already know most of these numbers. And also probably because, depending on the source, these numbers tend to be somewhat conflicting. So I just want to touch on a few themes and directional trends that are interesting for me, at least today. The first is that last year we saw $4 billion of global capital, or of capital, flowing into the venture ecosystem in Africa, 25% year-on-year growth. And while this is across the entire kind of venture ecosystem, what it does say is that there is capital again, and that there is growth. That's the good news. The bad news is that most of this funding went into debt as opposed to equity. And most of this growth came from debt, again, not necessarily equity. And most of this funding went into a handful of late-stage mega deals. So it was really driven by concentration in a few mega deals at the late stage of the company's, sort of the venture spectrum. And of this $4 billion, 30% of that went into climate tech, which is actually something that's a respectable number and something I think we should be proud of. The bad news is we still lag fintech, and so there's a little bit of a ways to go, and we have some catching up to do. Maybe the bad news is that this 30% number has stayed fairly static. I mean, it's kind of gone up and down a little bit, but the trend line isn't kind of more and more and more. And maybe the bad news is that most of this 30% again went into a handful of large late-stage mega deals. So what does that mean for early-stage entrepreneurs or investors? What does that mean for those who are seeking equity? These are questions I think we have to grapple with. The third thing that I think is interesting is really to talk about deal count and deal volume. And what this chart sort of says, and it's hard to read, but it basically says there's lots of activity happening at the early stage, lots of deals, small tickets, small amount of capital. And there's a little bit of activity happening at the later stage, a few deals, large deals, and a lot of capital. And it's somewhat linear in between. So all this tells me is that this is kind of the normal state of affairs for any venture ecosystem. You have a funnel and you go from lots of deals early to a few deals late. But if you talk to the early stage entrepreneurs and investors in the room, they'll say, there's not enough capital at our stage. This is the stage of the funding gap. And you talk to the late stage investors and entrepreneurs, and they say, no, but our stage is the funding gap. And so all I can conclude from that is that at every stage of the venture ecosystem, we have a funding gap. There's just a general shortfall on an absolute basis of capital in our ecosystem. But maybe the more interesting statistic as it relates to this is that the average timeline from seed to Series B for ventures in Africa is 5 years. The average timeline to exit is 15 years. So what does that mean for fundraising cycles? What does that mean for exit pathways? What does that mean for investor appetite to participate in this ecosystem when that's what the timelines look like? And finally, depending on the source, what we can basically say is that there is a bunch of activity happening in M&A, in secondaries, in exits. And this wasn't necessarily the case before. So that's the good news. The questionable news is that we don't know if all of these exits and these secondaries and this consolidation is happening from a place of success or a place of distress. We don't know if these were successful moments or sort of distressed exits. We don't know if early stage investors or entrepreneurs or founders made money or not. We don't know if these were stock deals or cash deals. We don't know a lot of things. So all we can conclude is that there is activity, there is hope, but we're not yet sure if this is all good news or bad news just yet. So how do we think about the year ahead? And how do we think about taking stock of where we are today and what that then allows us to do, if we take a moment to pause and reflect, is to think about where do we need to pivot? Where do we need to double down and lean in? And where do we maybe need to retreat? And for me, if I think about some of the kind of big themes that are happening as we look forward, the big cloud hanging over our heads for me is that there were a series of ecosystem shaping events that took place last year. And I don't think we have fully felt the full effects of those events on our ecosystem today, on capital flows, on customer preferences, on, sort of our pathways to growth. The first of those themes is really last year we saw a significant change and retreat from development finance in our ecosystem. Started with a pullback in funding from USAID. Contagion happened and it flowed over to changes in budgets and priorities from European governments. And this is going to have material impact on our community and climate tech in Africa in the year and years ahead. The second, and not to bring more bad news, is that there's been a significant retreat of global venture capital from Africa. So a pullback from European and US investors from our ecosystem. The data shows it, but I think we all feel it anecdotally. The good news, however, is that some of that void has been filled by capital from other regions. We've seen interest from Japan, from Korea, from Singapore, from the Middle East. And so that is a positive. But what it means for us as operators in our ecosystem is that we have to really understand that for these new investors coming from different regions, the stories are sometimes different. The risk appetite is different, the return thresholds are different, the motivations for getting involved in Africa is different, their timelines to exit are different. And so we have to be more aware, more conscious of our audience going forward in an increasingly kind of globalized world where we can't depend on capital from European and US investors or the development finance community. Thirdly, I don't think we've yet to feel the full impact of this kind of backlash in ESG investing and climate investing. It began with a bit of this kind of a rejection of woke capitalism in the US. It's kind of followed a little bit into Europe as well. And so the bad news, in a sense, is that we have seen many corporates and many global foundations and endowments temper their climate objectives, pull back from their climate mandates, be a little bit softer in their language. That being said, we are also seeing that there are a few who are doubling down, who are leaning in, who see it as their kind of mission and mandate to really stay committed to climate and to climate objectives. And so we, again, as an ecosystem, have to figure out how to tap into those groups and really continue to engage them in the right ways. And finally, genuinely, we have no idea about the medium-term impacts on climate tech in Africa of what's happening around us, the global upheaval that's happening around us today, the war in Iran. We know that oil prices are spiking. We know that supply chains are being disrupted. We know that fertilizer is not available. We know that interest rates are creeping up and up. But what is that going to mean for us as we operate in the year or so ahead? But we have to somehow believe that in moments of crisis and in moments of upheaval and in moments of market dislocation, that there are opportunities for us to thrive. And so I'd like to talk about a few of those themes today. The first that I'll touch on, is the idea that we are, as climate tech entrepreneurs or climate tech investors in our ecosystem in Africa, we are now living in a world where we're talking about green discounts, not green premiums or premia. What that means is that, we look at the price and efficacy of solar panels, of batteries, of electric vehicles. I mean, the trend is in one direction. It is directionally, better, cheaper, faster. And what that means is that now the conversation for us is no longer about, technology and cost points. It's about distribution. It's about financing. It's about product market fit. It's about things that are more in our control and more that we are able to kind of do something with. The second is this idea of shifting our mentality from focusing on digital only to phygital models, the intersection of physical and digital. How do we change the narrative that physical is a bug and not a feature? How do we change the narrative to make it seem that physical is actually defensible and not capital intensive? This is a real opportunity for us and a change in mentality that we have to kind of promote. The third is that we are operating in a capital scarce environment. I mean, I think there's no debate about that. And unfortunately, and I don't like to say this, but I think the unfortunate reality is that for climate tech in Africa in 2026, the priority of capital is going to be scaling what works, scaling what's proven. And that means that might have tough implications for things like, investment in novel technologies, in innovation, in first-of-a-kind projects. But it is the reality that we're living in, where capital is looking to scale things that are proven and somewhat de-risked. Next, how do we turn this kind of geoeconomic crisis into an opportunity? How do we capitalize on some of these transition tailwinds? When oil prices are spiking and are where they are there opportunities for distributed renewable energy? Are there opportunities for productive use electrification? Are there, motivations to continue this the energy transition? Or when supply chains have been disrupted and fertilizer is not available, how do we think about that as creating opportunities for domestic fertilizer production? How do we think about that as opportunities for, investment in soil health interventions or agri-lending, or sort of how do we create investable themes around this moment of crisis and turbulence? And finally, how do we shift from a mentality about kind of, globalization necessarily being a bad thing, where China is flooding the market with cheap cost products and low quality products, to one where we think about this as kind of an enabling environment? Africa imports of electric vehicles from China last year increased 184% year over year. Solar panel imports increased 60% year over year. How do we tap into other markets, whether it be Southeast Asia, the Middle East, India, and use that to our advantage and kind of connecting technology that's already been developed or brought down to a certain cost point to our advantage? So where does that leave us? And let me conclude with a little bit of some thoughts on the role that all of us in this room have to play in the journey ahead. So first, the LPs. This is what people call kind of the investors in the funds, who then go on and invest in entrepreneurs and in businesses. So the sources of capital ultimately. What are we hearing from these LPs? Well, we're hearing that, there's a increasing risk aversion. They're struggling with having success stories and exits. They want returns. They want returns in reasonable timelines. They want impact. They have mandates that they're trying to push. So there's a lot of requirements that they're pushing down the value chain. So what do we need from the LPs in the room? Firstly, we need clarity. How do you prioritize? Are you prioritizing impact? Are you prioritizing returns? Are you prioritizing return of capital? Give us, don't pick all of the above. Help us to understand really what are your priorities. The second is commitment. In a moment in time when capital is scarce, we need more of these investors to be leaning in to deploying capital and to kind of promoting and continuing to support this entire ecosystem. And finally, a long-term mindset. In the journey that I talked about, where it's 5 years from seed to Series B, it's 15 years to exits, we need patient allocators. Next, the GPs. These are the fund managers, the general partners, the people who are investing in, or the institutions that are investing in entrepreneurs and businesses. What are we hearing from the GPs around the room? I mean, they're saying our fund model is not necessarily appropriate for the investment strategy in the region that we're investing in. They're saying there's not enough pipeline, and if there is pipeline, too many companies doing the same sort of thing, little differentiation. They're seeing valuations maybe still haven't corrected in line with where they need to be given the market environment. They're needing success stories. So what do we need from these GPs? What do we need from the fund managers and the investors in the room? First is speed. How do we get to no's and yeses quicker and faster to give entrepreneurs more clarity on their own path and their path forward? Next, conviction. How do we lead rounds, set terms, lean in, know our mandates in a better way so that we can, again, give greater clarity to the entrepreneurs that we're engaging with? Collaboration. How do we think more about building our ecosystem, having more success stories, creating a rising tide? Because at the end of the day, we need more co-investment, we need more data sharing, we need to create a bigger and larger community. And finally, transparency. Fund managers in the room, when you engage with entrepreneurs, tell them when you're still fundraising. Tell them when you are at the end of your investment period. Tell them when you have follow-on capital, you don't have follow-on capital, you make follow-on investments, you don't make follow-on investments. Your return expectations, your exit timeline expectations, your impact expectations. Again, give them the playbook to then better work with us. And finally, the entrepreneurs. What are we hearing from you? We're hearing there's no capital. When there is capital, these investors are not leaning in, they're not taking risk. We're hearing they're not taking the time to understand our business models, they're not engaging with us with empathy. They're unrealistic about their expectations of us. I mean, these are all valid and true. So what do we need from you as entrepreneurs? I mean, the first is creativity. The successful climate tech entrepreneurs today are going to be able to be creative about creating capital structures and capital stacks to suit their businesses. How do you use equity and debt and grants and technical assistance and revenue-based financing and results-based financing and carbon financing and whatever you can get your hands on to support your business in its path to scale? Second, flexibility. How do you, I mean, in a way, listen to your customers, listen to your markets, and pivot. Listen to the investor community. And if for some reason capital doesn't feel immediately available or obviously available, maybe you have to pivot or adjust. Because that leads us to pragmatism. Unfortunately, today, moment in time, climate tech in Africa 2026, survival is the only thing that's going to matter, right? So founders that can raise money and survive are going to win. And sometimes being theoretically correct around terms or valuation or business model or whatever it is, if you're not able to get funded, you're not going to be able to have the long-term impact that we need in our ecosystem. And finally, know your market. Know who you're raising capital from and their constraints and what's going through their heads. Climate tech investors in Africa today are not out hunting unicorns. They have not seen success stories. They have not seen exits. They are looking for resilience. They're looking for certainty. They're looking for proven things that they can help scale. Is it right? Is it good? Not necessarily. Unfortunately, the groups in the room that are supposed to be taking outsized risk for outsized return are becoming more and more risk averse. So what it means is that as entrepreneurs, you have to show pathways to profitability sooner than you might think. Unit economics that make sense sooner than you might think. Capital efficiency. Large GMV, large gross market value businesses with small margins aren't getting funded as much today. Businesses that have long R&D cycles, long innovation cycles, long paths to monetization, they're not getting funded as much today. Businesses that are dependent on single revenue streams or carbon finance are struggling. So how do we, being the best alone in Africa is not good enough if we have to compete on a global stage. So at the end of the day, what do we need as a community? In the year ahead, we need more resilience and more perseverance and more commitment, because there are going to be bumps, there are going to be challenges. We are operating in a very tough market environment, but at the same time, there are real opportunities to come together as a community, to take advantage of this market dislocation, to support each other, and to really build fantastic climate tech businesses that have real climate impact and real commercial viability in a path to scale. So thank you very much for listening to me today. And I enjoy, kind of hearing the conversations and debates and the panels that will follow. Thank you very much.